So we've got some new drama between Novo Nordisk and Hims, and this could have a huge fallout. So as you can see, Novo Nordisk is suing Hims and Hers over copycat versions of Wegovy drugs, and Hims stock fell as much as 18% in one day, which was February 9th. This is not the first time these companies have had issues. In fact, in 2025 last year, they had a partnership in April, and then it was terminated by Novo in June over allegations of deceptive marketing and illegal mass compounded or knockoff versions of their medications on behalf of Hims. They've accused Hims of knocking off their products last year, and now we're having more issues again this year. So now Novo Nordisk is asking the court to permanently ban Hims from selling compounded versions of its drugs that infringe on the company's patents. They're also seeking to recover damages. So this could end up costing Hims a lot of money on top of their free-falling stock. So this obviously escalates their feud. According to Novo, they estimate that 1.5 million Americans are using these GLP-1 drugs to essentially lose weight in the past month. So there's a huge demand for these types of drugs, and we have this huge issue where Novo Nordisk makes these products, and now they're saying allegedly that Hims and Hers is knocking these off and selling them at lower prices. So Novo is actually up 3.63% today. Hims is down right now around 16%. They were worse, obviously around 18%. Now it's down 16%. So of course, now we have to question, would either one of these be a good buy right now as a stock? So let's start with Novo Nordisk. Novo Nordisk, again, up right now. If we look at how they're doing, they do have a really low PE ratio, which is nice to see. They do offer a very generous dividend as well at 3.74%. They're not doing too great though over the past year. They're actually down 41.16% in the past year, which is obviously not good at all. Again, if you're trying to buy individual stocks, in my opinion, you're trying to beat the S&P 500, and that's kind of the whole point of picking your own stocks. You would have been up 15% in the past year if you had just held the S&P 500. Now, if you look at Hims over the past year, they're actually down 56.82% in the past year. Now, if you look at the last 5 years, they kind of peaked around 2024, and then ever since then, they've been kind of just going down from there. They also missed on their last quarterly financial report by 7.63%. Unfortunately, on revenue, but they did beat on earnings, EPS, as well as revenue by a small margin, of course. So there are a few things to like here. Again, they beat on their most recent earnings report, although the one in June was not too great. They have a really nice dividend. 3.74% is quite generous, and their PE ratio is low, meaning it could possibly be at a bargain based on the earnings of the company and the price of their stock. Now, if we compare that to Hims over, the past 6 months alone is down 61%. Over the past year, 56%. Over the past 5 years, they're still negative, down 13.94%. If you compare that to the S&P 500, you would have been much better off. You would have been diversified, and you would have gotten a return of almost 77%. Even the Dow Jones would have gotten you around 59% over that time span. I also like to look at how a company has done over the past 3 months, because essentially that is a quarter of a year, and they are up 7.42%, that being Novo Nordisk, while Hims is actually down 55% over the past 3 months. Now, if we go a little more in depth here, if we look at Novo Nordisk, they actually have greater assets and liabilities, not quite a 2-to-1 ratio yet, but at least more assets and liabilities. Now, their return on assets and their return on capital are actually quite strong. Normally, you want like 5 to 10% or 8 to 15% respectively, and they are blowing both of those out of the water. So return on assets, return on capital look really good. PE ratio looks really good. And there are actually some things to like here. Now, if you look at how Hims is doing, if you look at assets versus liabilities, not too much difference there in terms of ratio, not quite a 2-to-1 ratio, more assets than liabilities, though. Return on assets and return on capital are quite bad. Only 1% on both of those, which is well below what you are normally looking for as even a baseline. So some red flags here about Hims for sure, just looking at their Google Finance pages. Now, if we look at the trailing PE ratio, which is something you can find on Robinhood instead of the forward PE ratio, which is typically on Google Finance, sometimes these are a little bit different. Sometimes they're essentially the same. It just depends. But I like to look at both just to diversify different points here. 13.66 for Novo is about the same as you would find here. It's about exactly the same as what you would find on the Google Finance page. Now, if you look at HIMS, if you look at their PE ratio, their trailing PE ratio here, 42.56 compared to 35.22, which is what you would find Google Finance. So that's actually worse when you look at the trailing PE ratio versus the forward. Now, of course, some of these numbers are a little bit off at times. Like they say the dividend yield is actually lower on Robinhood versus Google Finance, but either way, whichever one you're getting a nice dividend. If you look at what 34 Wall Street analysts are saying about Novo Nordisk right now, 53% or so are saying they are a buy, which is barely over half. That's not the most confidence in the world. Hold 35%, that's pretty high for a hold score, and they do have almost 12% saying you should sell. Now, if we look at their earnings calls, they've done pretty well on the last few reports. Obviously, you love to see that, although they have had a few misses over the last few quarters. Now, this information was not available on Robinhood for Novo Nordisk, but if you look at what hedge funds are doing, this is always kind of interesting just to look at. This, of course, not financial advice in any way, but if you look at what they are doing with HIMS, they have actually bought more shares than sold over the past few quarters. In fact, in Q3 2025, 84% of hedge funds were buying and only 16% were selling. So it seemed like they were trying to buy the dip on HIMS, but these new allegations are definitely not going to help those hedge funds that bought that dip, as you would say. Now, we do have 19 Wall Street analysts that have covered HIMS, and they are saying 63% of these are saying they should hold, which is not a big vote of confidence. Only 26% are saying you should buy, and 10.5% are saying to sell. Not usually what you would want to look for if you were interested in acquiring a stock. And if you look at how they're doing on their earnings calls, just as a little graph over time, they did have a really strong Q3 in 2024. They were doing well going into 2025. And then as soon as all of this started happening with Novo Nordisk, they've been missing on their estimates and they've been lowering guidance over time as well, which is definitely not good. And this was before the latest news just came out today. Now, if we look at Novo Nordisk and their PEG ratio, their forward PEG ratio forecasted 12 months, they actually have a 0, which means they may not be profitable. A lot of times is what that means. So that's not usually what I would want to look for here. Although usually if it is above 0 and it's low, usually around 1 or a little less than 1 is what you would like to see. If you look at HIMS, you would see that their PEG ratio is actually a little bit high. So it's a 4.4. And of course, this is kind of like a PE ratio, but it also factors in growth rates. And usually 4.4 is it's quite high. It's not usually seen as a great bargain based on their earnings, their growth rate over time, and the price of their stock. Now, if we look at their EV to EBITDA ratio, another alternative metric to something like a regular PE ratio, it's a little bit more of a raw number that can't be manipulated as much by accounting or taxes or all these different things that you would do on the books. Then you look at the score for Novo Nordisk, and you can look at the score by itself being a 9.81, which seems pretty low. And then if you look at how it ranks versus other drug manufacturers, they are actually better than 70% of them. It's very rare lately for me to find an EV to EBITDA ratio that's actually positive, that's actually in the green here. A lot of them are worse than average lately. But if you look at the EV to EBITDA ratio for HIMS and HERS, you have a 34.16, significantly higher score here. And then if you look at how they are doing compared to other drug manufacturers, basically the same sector as Novo Nordisk, they are actually worse than 85.21% of those 730 companies, which obviously another red flag. Now, to get an idea of whether or not they have good leadership and whether employees believe in the direction of the company, we have the Glassdoor official page where their employees can leave feedback after working somewhere. Novo Nordisk has been nominated as a best place to work on Glassdoor. It's a great sign already. Now, we do have a 4 out of 5 star rating, which is great. That means more than 75% of people who have worked here gave it a pretty positive score. 77% recommend working here to a friend. 76% approve of the CEO. So very good scores all the way across the board from people who have actually worked here and seen the inner workings of the company. Now, if we look at Hims and Hers, we have a little bit of a different story. Again, a company pretty much in the same sector as Novo Nordisk. Hims and Hers is pretty controversial, apparently. So a 2.8 out of 5 star rating, 36% of employees recommend working here to a friend. That's not good at all. Way less than half of them actually seem to have a good experience here. And then only 38% approve of the CEO, which of course is in charge of making the big decisions there. Not good at all. Pretty much a big red flag here. I mean, none of these metrics by themselves are supposed to really be a make or break for buying a stock, in my opinion, but there are so many red flags for Hims and Hers right now. So as you can see by the breakdown here, it's pretty clear that one company looks a little bit better on paper right now than the other. Novo Nordisk looks like a little bit better of a stock right now. They seem to have the moral high ground right now. We will see, of course, how all of this publicly plays out and whether or not they were right about what Hims and Hers is doing, and if these allegations end up being true, and if Hims and Hers has to pay damages or they have to stop making certain drugs. This could be a long-term huge problem for Hims and Hers if this ends up being true. And they already seem to have some signs of problems with their stock price, but also their culture as a company for people that have actually worked there. Now, if you want to ask me, like, would I want to buy Hims and Hers right now? Personally, I would not. I don't see a lot of good signs here for Hims and Hers long term. I think this could end up being a multi-year problem. They may never recover from this. Or, they seem to have a bad reputation in more ways than one. Obviously, we need to see how this plays out and figure out what's true and what's not. But based on the information I have, I would not be interested in Hims and Hers right now. I would probably give them more of a sell score. If you have Hims and Hers and you're not sure what to do with it, it's a rough situation to be in, because if you sell now, you're selling really low. There's a possibility it could get worse, though, and I think there's a good chance that will happen. But maybe you can get a bounce back. Maybe some of these allegations aren't true. Maybe you could hold a little bit longer. It really just depends on your risk tolerance at this point. But I am just really glad that I am not involved in owning Hims and Hers stock right now. Now, if you look at Novo Nordisk, they look a lot more attractive than Hims and Hers right now. The question is, would they actually be like a stock worth buying if you don't already have it? For me, I don't see quite enough of what I typically look for. I'm pretty picky when it comes to this kind of stuff. I'm trying to beat S&P 500 long term, so I have to be extremely picky on the quality of the company, the price that it's at right now, what they're doing long term, their leadership, etc. But there are some good signs here. They could be a solid dividend stock if someone were in a scenario where they were looking for maybe a diversified portfolio for income. Maybe you're a little bit older and you're trying to retire, or you're trying to retire early and you're not as focused on growth. If you're focused on growth, I'm not really sure I see Novo Nordisk being a great option right now. Unless this ends up being like another spike like they had around 2024. I just don't know if I see a lot of like long-term growth compared to so many other stocks that are out there that are probably going to give you some massive growth. Like even just AI and AI infrastructure alone, there's so many high growth stocks right now. But if you want something more conservative that just gives you consistent income in the form of a dividend, you want to buy something that has a low PE ratio that may seem like a bargain at the price compared to their earnings, I could definitely see people convincing themselves that Novo Nordisk could be a good one to have in those types of scenarios where they're not as focused on growth necessarily. Of course, none of this is financial advice. Everybody's situation is totally different, and please do your own research or consult a financial advisor before making any big decisions.